Welcome to another episode of the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe, and this is another one of our multifamily brief episodes. Today, I wanted to talk about, how to get deals done right now. I mean, technically, we are still in a seller's market. I've talked with a lot of people who can keep their finger on the pulse of the market, and we are still in a seller's market, even with interest rates going up. And why are we still in a seller's market? There's more demand to purchase than there is supply that's selling. And that's really kind of the factor that determines whether we're a buyer or a seller's market. And, sellers can a lot of times still dictate terms and still dictate pricing, So for the most part, we as buyers, and honestly, I'm on both sides of the fence right now. We've got a couple of properties we're selling. We as buyers, we do have to realize what type of environment we're in. Interest rates are relatively high, relatively high if you compare them to 1 and 2 years ago. It was this time last year where the Fed raised interest rates for the first time. And anyway, so we've seen a substantial increase in interest rates recently, which has made it a little bit more difficult to purchase properties. And really, I mean, that's what it is. It's been a little bit more difficult to purchase properties. So, your debt service has been a lot higher. A year ago, Fannie and Freddie could have given you loans in the 3% range, and right now in most products, you're getting, mid fives, sometimes even low sixes on your Fannie Freddies, depending on what type of market you're in, the size of the property, the debt service, the LTV and whatnot. So how do you make some deals work? Well, first thing I'm going to suggest is see if you can find a property where you can assume the loan. Two of our coaching clients right now are doing exactly that. They're going in, they're assuming a 3-point-something% interest rate loan, and that makes a lot of the numbers work out. Yeah, 3% debt versus 5 or 6% debt, of course. But when you do that, you just have to make sure that there's enough time left on the loan term that, you're not in a bind a year, 6 months, year, 2 years from now. So all of your agency loans are assumable, meaning your Fannies and your Freddies. And a lot of your other commercial loans are also assumable as well. So that's just something to ask, when you're putting in offers or when you're talking with brokers, and just ask the question, is the loan assumable? Now, typically when you assume a loan, you're going to come in with a little bit more equity. And with today's deals, with the big disparity between rates from, a year to 2 years ago and rates now, it may actually be more advantageous to come in with 40% equity with a loan assumption at a lower interest rate than it is to get a brand new loan at a higher interest rate and start making those higher debt service payments. I mean, your debt service payments end up being about the same, and you probably end up having to raise about the same amount of capital anyway. So long story short, on those deals, instead of getting, 75% leverage like you were able to get a year or two ago, come in at 60% leverage, get that, loan assumption done. And, you can start out at a 3 or a 4% loan instead of, 5s and 6s like right now. Something else is just to look at your structure. How are you structuring your deals? Kind of the bell of the ball over the last couple of years were the quick flips. You'd see a lot of syndicators hold a property for 12, 14, 16 months, and the market appreciation has made it now to the point to where they could sell it and make a decent profit. So we've seen that a lot, though most people didn't intend on doing that. I think a lot of people were just looking at where the market was and saying, wow, it makes a lot of sense for us to sell right now. We can cash out, we can make a lot of money. And, a lot of investors weren't complaining. But, right now when we're looking at deals, the short-term hold option or the flipping option where you're coming in with a massive value add and you plan to sell in 3 years, I think a lot of times there's a little bit more risk to that because of where we are at in the economic cycle right now. We can't necessarily count on that appreciation to be there. So once again, I think a better model right now is let's extend things out. So instead of looking at a 3 to 5 year sale, why don't we look at a 7 to 10 year, hold time? And we can model a refinance in there. Those are a little bit tricky to do, properly, but you can model a refinance in there at, year 3 or year 4, give it enough time for natural appreciation to take its course, put a refinance in there around year 3 or year 4, and return all the investor capital and then hold till 10-year mark. And it's a different investment strategy. It's one that I'm tending to gravitate a little more towards in these economic times. But what it does is it puts time on your side. Absolutely. Over a 10-year period, the market is, almost certainly to go up. Over the next year, who knows what's going to happen to the market? It'll probably go up, but it might not, is the question. So, and what this also does is this creates a passive income stream over a 10-year period instead of 12 to 18 months where you might do a couple of distributions and then there's that big pop at the end. I'm not saying either one's right or wrong. They are different investment strategies, but we are in the economic cycle. I'm leaning towards the longer term hold on the properties because we have more time for, if there is a continued correction or if prices go down or if rents flatline for an extended period of time, we have time to see that through. Anyway, that's it for today. Like I said, we're working on a couple of deals like that with coaching clients where we are assuming loans and the numbers look fantastic. So give it a try, see if it works for you. Anyway, we'll see you again on Friday when we release our next Ask the Expert episode. Thanks, guys.
Hey, if you like that episode, make sure to subscribe. But more importantly, if you haven't joined our multifamily educational community yet, which we call the Tribe of Titans, you are missing out. Get 30 days free by clicking the link in the description to this episode or go to thetribeoftitans.info and we'll see you there.